Why do some oil and gas contractors pay dramatically more for insurance than others, even when their operations appear similar on paper? Insurance pricing in energy operations is rarely based solely on revenue, payroll, or vehicle count. It's based on operational exposure, and many contractors don't fully understand what insurance carriers are actually evaluating until premiums increase, coverage becomes restricted, or a claim exposes weaknesses in the risk structure. Energy operations create layered risk, fleet liability, environmental exposure, driver quality, subcontractor oversight, contractual obligations, excess liability exposure. The more complex the operation becomes, the more aggressively underwriters evaluate risk. For oil field trucking and energy logistics companies, fleet exposure is one of the largest pricing drivers. Insurance carriers closely evaluate driver screening, MVR history, telematics, maintenance programs, accident trends, DOT compliance, and subcontracted driver exposure. Severe trucking claims and nuclear verdicts have dramatically changed the commercial auto market. A company with poor driver oversight or weak fleet controls may become significantly more expensive to insure, even if losses have been limited so far. Environmental exposure is another major factor. Many energy operations involve fuel handling, chemical storage, tank operations, spill exposure, hazardous material transport, or work performed at environmentally sensitive sites. Underwriters assess both sudden and gradual pollution exposure, along with emergency response procedures, environmental controls, and regulatory compliance history. A single pollution event can create severe cleanup costs, regulatory action, and long-tail liability exposure. Contract structure also impacts pricing more than many contractors realize. Energy companies often operate through layered subcontractor relationships and project-specific agreements. Underwriters evaluate indemnification provisions, additional insured requirements, subcontractor insurance standards, and downstream liability transfer. Poor contractual risk management can significantly increase both pricing pressure and claim exposure. Loss trends remain one of the strongest underwriting signals. But sophisticated underwriters also evaluate operational discipline. That includes safety programs, training procedures, fleet oversight, incident reporting, maintenance controls, and environmental compliance systems. Strong operational controls often improve both market access and long-term insurability. As claim severity increases across the energy sector, excess liability has become more important than ever. Many operators underestimate how quickly catastrophic trucking claims, environmental incidents, or multi-party project losses can exceed primary policy limits. Excess liability pricing is heavily influenced by the overall quality of the operation and perceived catastrophic exposure. Most energy contractors don't realize where insurance pricing problems actually begin until a renewal becomes difficult. Premiums increase dramatically, or coverage restrictions appear. Sophisticated operators review operational exposure before those issues develop. If you want a second look at how your insurance structure aligns with your operational risk, fleet exposure, environmental liability, and contractual obligations, click the links in the description to learn more or schedule a consultation. Montridge Insurance Services specializes in helping energy contractors, industrial operators, and high-risk businesses structure insurance programs around real-world operational exposure, not generic coverage templates. Thanks for watching.